you probably don't know something that everyone else doesn't.
Correct.
As
yes.
much as we like to tell ourselves sometimes, it's like, oh, I've got this gut feeling like this is going to work. It's like, now's not a good time to like roll with that gut feeling. Because, in these markets, the way the markets are moving, that's when you can really get burned.
Comments in this episode about markets, economic conditions, or political developments reflect personal opinions and should not be taken as predictions, guarantees, or statements of fact. Forward-looking discussions are uncertain and may not occur. All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Lee.
Good morning.
And we've got a couple things we want to talk about today. A lot going on in the world, a lot going on in the markets. Some good and bad things happening kind of all over the place. And so I want to talk about a couple things relative to the market and the economy. To start, let's talk a little bit about, how the market started the year. We've touched on this over, on previous episodes here recently, but there's one chart in particular that we'll have Zoe throw up for those watching on YouTube. So this chart or graph is titled Diversification at Work. So it's software, so the software sector versus the S&P 500 as a whole. So if you look at, since 2005, the software this chart goes back to 2005, and then it shows year to date the drawdown for software versus the S&P 500, at 25.5% for software and 2.6% for the S&P 500. Really touches on the value of diversification. You and I were talking about before we got on here how easy it has been to own the best performing companies in the world, because those have been U.S. large cap technology companies that make up the biggest part of the indexes. And so essentially all you had to do is buy the S&P 500, buy the Qs, and you were going to be doing as good or better than anyone else from a return perspective. But we get into times like this, and historically there have been many, many other times where that's not true, and certain things start to really work, certain parts of the market start to not work as well. And so, they're good reminders of why you want to have different allocations to, different parts of the market, to different asset classes, different assets altogether. So we've definitely seen some value here coming back with diversification, not only software relative to the S&P 500, but also, look at international, what it did last year, kind of as well, starting the year, what gold and silver has done over the last year or two. Fixed income had a great year last year. Like a lot of things over the last 12, 18 months have started to perform that weren't performing, and certain pockets of the market that have had maybe some really tough stretches that, if you were overexposed, you felt that.
I've talked about this before on the podcast, the whole 60-40 and, how we were kind of trained in the business, that 60-40 strategy, man, there were a number of years where that just didn't work. And to your point, if you had invested in the S&P 500, the NASDAQ 100, and even more specifically, had you invested in, those top 5 or 10 stocks, you really didn't need any other part of the market.
Yeah.
Last year, those still performed, but it was value, to your point. It was international, which was one of our best, sectors here at Mach 1. Fixed income did well as rates came down. And, and to start the year, what are we, 2.5 months in? That theme has kind of held, value, international, fixed income to a lesser degree. And you were gonna mention software, specifically. Man, they've just gotten their hat handed to them.
Yeah, it's been tough.
Oh, it's been brutal.
Some would say a little overkill for sure.
Oh, yeah.
With the AI scare of like, are we going to need software companies anymore? And I think the market investors got out ahead of themselves.
We're in a period right now where there's not a lot of middle ground. I mean, there's not a, calmer heads don't prevail in either way. I mean, it is either we're selling everything, we're buying everything. But then last week was an interesting week. Software out of just getting, their teeth kicked in for the first, 2 months of the year. What did you say before we started? Down 25% to start the year. Last week when really everything else was selling off due to the conflict in Iran, you have software index goes up pretty nicely. And, probably due to the fact that it was so overblown. And some of the software companies that we've talked about, are not going anywhere. But it was time for them to, to get back to kind of what they had been doing in the past. But diversification right now, we're in a market that, nobody even pays attention to the price of oil, really, until
I was about to say, except for the last
until, I think we were in the 60s 2 weeks ago.
Yeah, it was around 70, give or take.
And then yesterday pre-market, this was while we were sleeping Sunday night, the price of a barrel hit 120, 121. Now, it settled way farther than that down. But we're in a weird time right now. It doesn't mean that the Walmarts and the Nvidias and the Microsofts and, it's not like people are not still shopping and so forth. It's just, man, there's a lot of uncertainty.
Trying to figure out and predict what is going to happen, what is going to perform well over the next, the short to midterm, 6, 12, 18 months. Very difficult.
Sure. And
it always is, but.
Absolutely. And we've said it many, many times on this show, is that the markets hate uncertainty. The markets don't mind bad news. They hate uncertainty, and we're in a world full of uncertainty right now. And a lot of it does hinge on, if oil tankers start, going through the Strait of how do you say that? Hormuz, then we're fine. You'll see oil drop back and life will go on. But if all of a sudden we look up 2 weeks from now, oil tankers are still parked and oil's not moving, then we got, it's a different world. And so, I was going to bring up, we don't talk about stagflation a lot because it doesn't happen very often. I think this conflict, it caught everybody off guard, and what stagflation is you have an economy that is really not going anywhere, which some of the latest numbers, job numbers, kind of point to, with inflation. Okay. And so you have a period of inflation, which we still have some, and then you have an economy that is not growing. Doesn't mean it's in a recession. It just means it's not growing. Those are two things that don't go well together. And the cures for it are typically lower interest rates, government spending, which in turn fuel inflation. Yeah. And so I'm not saying we're in a period of stagflation, but if oil gets up there around $100, $110 a barrel for a prolonged period of time, because that's going to go right to the gas pump. That is a tax on everyone, especially to your lower middle class, to where, the price of gas goes up $1, $2 a gallon. People can't stop driving. They still have to go to their jobs and take their kids to school and so forth. So that's something to watch for. You'd hate to see a lot of the positive impacts of Trump's big, beautiful bill get nullified by, kind of what we're going through right now. But, if John were sitting here, John would probably be the pessimist or the glass is half empty. But it'll be interesting to see kind of what transpires over the next few days, few weeks.
Yeah. I don't know what the right answer is. I would hate to be in the driver. You've got a new Fed chairman coming in.
Yeah.
At a point in time where, unemployment is ticking higher. Inflation is just, it's not, I wouldn't say it's like higher than it has been. It's just, it's stubborn. It's just kind of hanging around.
So what do you think this does, in your opinion, to the prospects of a new Fed chairman in 2 months. Okay, so we're 2 months away. What do you think this does to the prospects of a rate decrease? I mean, takes it.
What does? Like just the current, yeah. I mean, they're not going to be able to cut rates if oil is super high and inflation's out of control.
I would agree.
But it also depends on the labor market, where's unemployment. I think they could afford to cut, but they don't. It doesn't mean they have to, because they come in and say, hey, we're going to cut 25 basis points. It doesn't mean they have to come in and say, hey, we're going to be on a path to cutting 100 basis points over the next few quarters.
Yeah.
Like it's kind of quarter by quarter. I mean, if you feel like you need to cut 25 basis points, that's not going to move the needle one way or the other in a huge way. And then you adjust, I know the market doesn't like that because the market likes, to your point, more certainty around what's coming. But yeah, there's a lot of things up in the air right now. I think it's going to all shake out, okay. But it doesn't mean that there's not going to be some pain to get there and some higher oil prices. Maybe unemployment ticks up a little bit.
Who do you think? And I'm going off script, so apologize. Who do you think this benefits? The conflict we're having if we do have, if we do have higher oil prices for a while. I mean, who do you see this benefit other than oil companies, other than the Chevrons and the Exxons of the world? Does this benefit anyone? I mean, do you see
higher oil prices alone, or what?
Or just the state of uncertainty? I mean, we're in a midterm election year, so there's not a whole lot going to happen in Congress. But I mean, is there a winner that comes from this?
If you have high oil prices and unemployment ticking higher, then Democrats are the winners going in midterms. Because that's just a tough story to manage through.
Sure.
And just bad timing if it's hitting right at midterms.
Yeah.
So I mean, if you have persistent inflation trending higher because of high oil prices, unemployment ticking higher, it's like
a recipe for.
Yeah, I mean, it's just historically what has typically happened will happen again. And the Democrats, because Republicans have the White House, Democrats will win the midterms, generally speaking. So, no, that doesn't mean all of that's going to happen. But, yeah, I think they're, the benefactors of that kind of situation.
It's nice. I'm looking at the markets today. It's kind of nice to have a normal day.
Yeah. It's only 8:50.
It is. The markets have been open for 20 minutes.
I mean, you've seen what's happened the last few days.
Yeah, yesterday was
wild. I was in a client meeting, and going into the client meeting, the market was down in a
1%.
Way. Yeah, like 800 points.
Yeah.
On the Dow, Lee Mackey.
Yeah,
and
old school.
Came out of the meeting and everything was green.
Yeah,
I was just like, what in the world? So.
Yeah, we're living in kind of a
that's kind of a
time.
Perfect example of just like trying to figure out, just headline driven.
The one thing that has caught me by surprise a little bit is typically when you have these conflicts around the world, money goes to safety, and our 10-year typically goes down. Our 10-year went up.
Mm-hmm.
Our 10-year had hit 3.9%, and right now it's around 4.1. But in usual world conflicts, when there's unrest, people want safety and stability, and money pours into our treasuries, forcing our yields down. And it didn't happen this time. And so I found that to be,
there's a lot of factors that go into, there's some kind of, there's some questions around the private credit space right now, and some uncertainty, some uneasiness on what's going on in the private markets, in particular with the private credit. But then you've also got a situation where we've got ourselves from a national debt perspective in so much debt that like we can't afford for rates to be high. I mean, so you start playing this out of like, okay, rates need to either stay where they're at or trend higher because inflation is so bad or blah, 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 whatever the situation. It's like, well, that's very negative for other things, right? Whether it's from national debt and whatever. So it's like it's going to be tricky to get everything right with all of this going on at the same time. There's going to be some sort of something's going to be impacted in a negative way, right? It's just a matter of what is that and to what extent.
And throughout all this mess, I kind of forgot until this morning that we're still under a partial government shutdown.
Yeah, DHS. Don't be aware of what TSA is doing at your local airport.
And we just, we flew over the weekend. Fortunately, and maybe that's why I was completely oblivious to it, because we sailed through TSA pre-checks and so forth. And then this morning I see the news of, 3-4 hour long wait, Houston Hobby. The line went through the airport into the parking deck.
Yeah.
And I'm just like, man.
Yeah.
Welcome to reality. So there's a lot going on. This is not unusual. I mean, this happens. We get calls now about how things are going to affect portfolios and so forth. And, it's, this story has played out before. Markets are resilient. I mean, the markets are overall down 5-7%, which is kind of par for a typical year. Not unhealthy, not pleasant all the time, but markets are resilient. And
I think my takeaway would just be, right now in particular, it always is hard to have extremely high conviction, from an investing standpoint.
Sure.
And but I would say right now is even more so. Like, be diversified. Have a, if don't get, you probably don't know something that everyone else doesn't.
Correct.
As much as we like to tell ourselves sometimes of like, oh, I've got this gut feeling like this is going to work. It's like, now's not a good time to like roll with that gut feeling. Because, in these markets, the way the markets are moving, that's when you can really get burned. And so I'd say keep it simple, be diversified, make sure you know the amount of risk in your portfolio, know the amount of risk that you're comfortable taking, and make sure your portfolio is aligned, and have a plan and kind of and ride this out. And the market's hanging in there. I mean, we're talking like it's all negative, and there is a lot of negative headlines and negative news, but like the market's hanging in there. We haven't had any like major blow-ups, relative to earnings or, anything that we've seen. So just hang in there. But there's a lot of junk going on, negativity and, around the market and inflation. And so,
and should things resume normal, there will be another instance, next year, the year after
we
that.
talked about last week about, geopolitical conflicts and how the markets, typically the 12-month forward return on the S&P 500, other than I think 2 instances, has been like pretty positive.
Yeah.
With the average being very positive.
Right.
So this situation is not unique. We've had a lot of, it is unique, but we've had a lot of other similar situations, oil spiking, geopolitical conflicts. And so, anyways, well, any parting words or thoughts?
No, just be patient, and turn off the TV.
Yeah.
Not everything is breaking news. I tell people that all the time. It's, that red breaking news banner scrolls across
Every
the bottom
day.
Literally the whole day.
Yeah.
It's like, it can't be that breaking news. So, but that's how they sell advertising.
Yeah, for sure.
Come to the podcast.
Yeah. Well, as always, we appreciate you guys watching and listening. If you have any comments or questions, be sure to shoot us an email or leave us a comment. If you haven't liked or subscribed, we ask that you do so. We'd love it. We appreciate that. And we'll look forward to seeing you guys next week.
Have a great week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.